transaction advisory practice at Eide Bailly, and we focus our M&A practice on middle market companies that usually range in enterprise value anywhere from $5 million to $200 million in value, kind of purchase price. I advise both buyers and sellers throughout the transaction process with a particular emphasis on due diligence, quality of earnings, working capital, and other accounting-related aspects of deals.
And I'm Chad Flanagan. I'm the partner in charge of our business valuation group. I've been with Eide Bailly for 20 years and get a chance to work with our appraisers to do business valuations for estate planning, transactions, and litigation. So we have a team of 15 appraisers scattered throughout the footprint of Eide Bailly. And we get a chance to not only work with clients in BV compliance, but also to help do some consulting work to help clients build value in their business.
And so today we're bringing this webinar to you. We often see that working capital is a somewhat confusing topic, either as you're growing your business or eventually going through a transaction. It's confusing for both buyers, sellers, and all stakeholders involved. Our agenda today will include basically 3 areas of focus. First section will be just a brief overview on some of the terminology used, some of the fundamentals of working capital. The second section will provide some information on valuation and how working capital impacts privately owned businesses and how you can best manage and work with or manage working capital. And this third section will go into a deeper dive into what I call kind of the 6 steps of winning working capital on a deal. You can make sure you're either the seller or buyer, and you get either a fair shake out of working capital or a little bit of a leg up. So the first area we just wanted to kind of highlight, just kind of a general sense of what working capital is. According to Investopedia.com, working capital, which is also known as net working capital, is the difference between a company's current assets and current liabilities. So pretty standard stuff. Measures a company's liquidity, operational efficiencies, and its short-term financial health. Then goes on to say, in a paraphrase, if the company has substantial working capital, then it should have the potential to invest and grow. If the company's current assets do not exceed its current liabilities, then it may have trouble growing or paying back creditors or even go bankrupt. So we consider this definition to be like technically correct, right? That some of that short-term liquidity, short-term financial health situation is correct. But as a company is looking to invest and grow, actually having a substantial amount of working capital might inhibit that growth to some extent, versus having a model where you might be able to have more deferred revenue, where your customers may be actually paying you to fund your growth strategy, might be a better approach. We often see that companies sometimes fail, not because they can't get more sales, but actually being able to fund that growth plan sometimes is.
Yeah, and as we look at, again, one of the reasons why working capital can be so confusing in a transaction or otherwise is that there can be different definitions for working capital depending on the context of it. So, just looking at financial reporting, we look to GAAP to help us there. GAP's definition would be very clear in terms of what makes a current asset or a current liability, and can really, in those situations, GAAP can help us define ultimate working capital. It really is a one-size-fits-all approach. Everything in GAAP looks to what a market participant would do as we look at fair value of working capital or other assets. But within the GAAP context, it would help us define what is a current asset or a current liability. In other places, such as valuation, as we do fair market value valuations for gift or estate purposes or other things, the standard of value there is fair market value. This would really look to kind of a willing buyer. So very similar, we think, to the GAAP definition. And again, it's just current assets minus current liabilities. As we look to transactional definition, this can be very specific to a buyer. Unlike the other two, we can include or exclude certain things that may or may not be a current asset. Best to have clarity in the beginning of a deal and really talk about maybe some of these unusual assets or liabilities, whether they meet the definition of current asset or current liabilities. Kyle will talk more about this, but we do see a lot of disputes in what makes a current asset or current liability. GAAP may be helpful, but best if you work out between the buyer and seller what is, again, a current asset or liability. And I think that brings us to our first polling question that Amy's going to ask.
All right, polling question number 1 here. What is net working capital? And you have 4 choices.
So we put this question out there to kind of prod a response, and I think we got the response that yes, technically, net working capital from a GAAP definition is current assets less current liabilities. Net working capital is also money that a business owner has invested in the business to carry it forward, and in certain aspects, more deal related and M&A focused, a lot of times net working capital is defined by current assets without cash or current assets or current liabilities without debt, including current debt. So it's actually all of the above. So,
I think we kind of tricked them, Kyle. We just really focused on current assets minus current liabilities. Okay, well, I'm going to kind of walk us through how working capital impacts our valuation approaches. And to start with that, let's talk about the different approaches that we use in any given valuation. There's 3 that we lean on quite heavily. They are the income approach, the market approach, and the asset approach. The income approach is really a function of looking at an investment like an investor would. What are the cash flows that this business is going to generate, and what are the risks associated with that? The market approach is one of my favorite approaches just because we can go to the marketplace and actually see how similar companies are being bought and sold. And then finally, the asset approach, which is really just looking to the assets and liabilities of the company, looking to the balance sheet, restating assets, liabilities to fair market value. And each of these approaches considers working capital differently. The income approach, as we look at the earnings stream divided by the risk of achieving that earnings stream, cash is king. We'll talk about that a few times throughout this presentation, but it's really not net income that pays the bills, it's cash. And so we need to understand when we estimate cash flow, what does the impact of growth have on cash? What are the assumptions around that? Kyle mentioned already how high growth can really impact and depress cash flow, and certainly that's consideration in the income approach. This is something that private equity groups look at quite a bit, discounted cash flows, looking at the future, and private equity groups will look at debt-free, cash-free deals. And so it's important for us to analyze our working capital and our working capital needs around debt-free, cash-free deals, and understand, more importantly, the implications of receivables, inventory, those kind of things. So we'll look at an example of that, the market approach as well. I think there's a lot of confusion in the market approach around if I apply a multiple that I took from the marketplace, what then do I have? Is it the value of certain assets? Is it the value of equity? How does working capital play in? So we'll show an example of that. And then, of course, the asset approach is much more straightforward. And that will be a quick discussion because that is much easier to analyze. So let's start with the asset approach. Here's an example of what that looks like. And for very asset intense businesses, this can be a very appropriate valuation multiple. The great thing about it is its simplicity. The bad thing about it is it doesn't very well capture blue sky and tangible. In regards to working capital, it can be very straightforward in that we're going to buy dollar for dollar your working capital. So it becomes more a matter of what is the quality of that working capital. Are receivables good? Is inventory obsolete? Those kind of things. But very straightforward. So for many reasons, this can be a great approach. Again, the limitation is if there's significant intangible value, it does not capture it very well. So we're going to move on from that approach already, but very straightforward. So if we look at the market approach, I mentioned a lot of the confusion comes from, all right, I've heard 5 times EBITDA is a good multiple. I apply that. Then what do I have? and it can be different depending on where the multiple is derived. So just to back up a minute, what we're doing there is we're really saying, hey, in the marketplace, we can observe that these companies sold at this deal price. If I look how those companies compare in terms of revenue or earnings before interest, taxes, depreciation, or EBIT or something like that, we can then derive multiples and apply them to our subject company. We just have to understand, was that deal price an equity price? Was it just for certain assets? What was included in the deal? And so in those situations where we have a multiple that represents an asset sale, we need to then add or subtract certain other assets that may be involved in the transaction. So a lot of, just making sure that you're consistent with how the multiple was derived. In that first example on the top, we just need to make sure that if the 48 million represented truly the value of goodwill, fixtures, equipment, and inventory, if our deal includes receivables, let's add that. If we need to subtract liabilities, those kind of things, you can match it up with your deal. If again you're buying stock, then you need to make all these adjustments. If I look to the bottom here and the deal was for a stock transaction, then presumably everything went with it, all assets, all liabilities, and we need to just adjust if there are any unusual items. If there's a $2 million home in the business, that's probably not included in the multiple, and we need to add that to the value. The other thing I'll tell you is that if you negotiate this transaction and there's 3 months of due diligence, and then at time of close, working capital is decreased by $3-4 million. Again, do we need to have a mechanism in place to account for that? Because that does happen quite often. So in the market approach, it's very important, especially for struct transactions, to have a mechanism and to measure working capital. And then we move to an income approach. And this one, it's really, working capital is important in 2 areas. One is it may suppress cash flow. It's a decrease to our cash flow that we use to capitalize the business. The second part of this is if there is excess cash, if there is excess working capital, we can dollar for dollar add that to the value derived under the income approach. So if we look at the slides, you can see here that we're looking at normalized pre-tax income to start. We look at growth, tax implications, and then we kind of get to a net income we feel good about. But we really want to make sure we convert to cash flow. And this just illustrates that we need cash flow of $186,000 and need to consider that in the transaction. So then we go on to value using a 20% cap rate. So I'm going to kind of just walk you through how this all affects our calculation. What we need to know is kind of forward looking what working capital is going to look like. So how much cash flow is that working capital going to consume? We like to look at trend analysis, so understanding current quick ratios. We can look to working capital as a percentage of revenue, and really do some analysis not only on trending, but what the industry is doing. So if we are noticing that we've been a lot higher or lower than industry average, will we return to the norm or return to industry average? That should all play into our assumptions going forward. And here's an example. So if we look at the last 5 years and we say that, hey, on a average, our working capital, the revenue is about 7.8%, and we know what our revenue is going to grow, we can anticipate what our working capital is going to grow. So 7.8% of every additional dollar of revenue needs to be reserved for working capital. That's one less dollar that we can use to distribute or pay out to shareholders. That's really what we're doing there, is we're looking to the future and saying not every part of our net income can be distributed or reinvested in the company. Some of it's going to be reserved for growing working capital. One thing I want to, as we think about how we may work with our clients to improve this situation, improve working capital, it's great to think about it in terms of the cash gap. So what this measures is really how long you're financing the working capital. And if we simplify it, we say receivables and inventory really make up most of the current assets, payables make up most of the current liabilities. We can simply add the receivables and inventory and subtract the payables, and here we've got basically 25 days that we need to finance working capital. There are some businesses that have a negative cash gap. If you think about colleges, universities, they get paid before they do any work or pay payroll. And so that's a great business model if you can, have large customer advances or whatever else. In most businesses, however, there is a cash gap, and the difference between 25 days and 10 days can be substantial. So working with clients to improve turnover in all three areas is good. And here's just a few ways. I'm not going to go through all of these, but I think there's literally books written on each one of these areas on things you can do to improve turnover, decrease days outstanding on inventory, receivables, certainly on inventory, just asset management. With some clients, we even recommend that, hire a procurement manager or somebody to make it their work to manage inventory, because it's such a significant thing, and, the benefits might outweigh the payroll cost to that. Receivables, of course, there's things you can do to consider discounts, get early pay, and sometimes it's as simple as cleaning up the invoice and the appearance of the invoice and communicate a little bit more clearly. Certainly follow-up plays in big there. And then accounts payable, we always suggest, don't just pay these as soon as they come in. Make sure that maybe you got to take advantage of early pay discount, but if not, stretch those a little if you can, not to the point where you're damaging your relationship with your vendor. We certainly don't want to give advice for that to happen, but take advantage of the time that you have with those. The last thing I wanted to cover is just that, this is a powerful impact to the value of the company. If I think about ways we help clients value their business and grow the value of their business, there's the easy stuff we can focus on. There's the, increase revenue, decrease expense, improve margins, keep overhead flat, those kind of things. But asset management is significant in that. For example, in this specific case, we found that the client had 100 days turnover in inventory. Industry average is about 45. So our industry average was 30. If we went to industry average, we could find that a lot of cash flow that would help increase the value of the business. In this case, $500,000. So it is important, especially for asset-intense businesses. I know some of you are in businesses that are a little bit more service-based, and there maybe receivables is the focus or other things like that. But it can really have a large impact to cash flow and to the value of the business. So just some last thoughts. We tend to focus quite a bit on earnings and revenue and those kind of things, but cash is really what buyers are interested in. And to the degree we can improve our asset management, we can help improve the value of the business. If you're on the buyer side, of course, what we're trying to avoid here is for you to buy the business and then 30, 60, 90 days later take an advance on the line of credit because you underestimated the movement of working capital. That really is, it pinches your credit availability, it adds to borrowing costs, those kind of things. And so I want to make sure you understand that going in. This is more difficult when you have a business that is very volatile. Some are seasonal every year, and that needs to be accounted for as well. So maybe the time of the deal versus where they're at in their cycle plays a role in. And I think the most important thing is just do your homework. If you are on the buy side, make sure you understand these cycles. Make sure you understand the impact of working capital. Make sure you are adequately financing the transaction to give yourself some room for movement in working capital. And that really speaks to both movement of working capital as well as some of the things we mentioned earlier, which is, what are my receivables worth? What is inventory worth? Those kind of things. So that brings us to our second polling question, Amy.
Okay, our second polling question here. Calculate the cash gap using the following information. Accounts receivable, 30 days. Inventory, 25 days. Accounts payable, 29 days. All right.
And that's A is correct with adding the receivables inventory and subtracting payables.
Leave it to an accountant's accounting firm's presentation. You do math.
We didn't even round the numbers, Kyle. We should have made it a little easier.
So going on to kind of deal considerations and now more into the mergers and acquisitions aspect of working capital, I think it's great to understand what the terminology and driving value out of the business, because you want to, first and foremost, you want to increase the enterprise value if you're selling a business, or you want to make sure you're paying the right amount if you're a purchase price, kind of that stated value. If you're acquiring that business, then you actually have to get down into the nuts and bolts and mechanics of working through the deal, and it's probably one of the least or most misunderstood concepts and contentious points during an acquisition or post-acquisition. So here I've outlined, I guess, 6 steps for M&A and net working capital. And I'll go through specific slides in each one of these steps and give some examples.
Hey, Kyle.
Yeah.
Sorry, a few of our participants are asking if you can move closer to your microphone or move your headset closer to your...
Sure.
Thank
you. Is
you.
that better?
Yes, that's better.
Okay. So these are the 6 steps for M&A net working capital, and really sets kind of the outline for going through the whole transaction, from what's going to go into this calculation, how is it going to impact me, both from a buyer side and a seller side, and what are how do you actually dive into the details and get this done. I'd say probably 90% of the deals we work on, the letter of intent says something along the lines of the proposed value of the deal or the acquisition will be X million to acquire X percentage of the stock or all of the assets, and it's to be done on a cash-free and debt-free basis. A lot of companies, as they go through, a lot of private equity groups, a lot of strategic investors as well, value businesses on that debt-free and cash-free basis, where the seller takes home all the cash but has to pay off all their debts. And what's defined as debts is then to be determined, and what's defined as working capital is to be determined. And then a lot of times the letter of intent goes on to say the valuation assumes the company has normalized levels of working capital and is subject to completion of due diligence. So the normalization of that working capital is subject to, or is to be determined as well. So there's a lot of movement, a lot of, I guess, dials to move in the next phase. I'll describe this is what I call kind of the 6 steps to winning working capital. And if we don't win working capital, we always want our clients to at least be neutral and not be on the short end of the working capital equation. Just as a general rule, the earlier that the sellers can establish kind of steps 1 through 4, the better for them. And for the buyer's perspective, if they can complete steps 1 through 4, after all the diligence is completed and they've had a chance to kind of nitpick at everything, that's to their advantage. And usually it's somewhere in the middle, but a lot of deals we work on, it's all kind of negotiated later in the process. And a lot of times from the seller's perspective, they're a little bit tired at this point of diligence, and they might have gone through a retrade on valuation, and there maybe will concede part of the net working capital value during the acquisition. So on this next slide, I just gave kind of an overview of how we look at working capital per balance sheet during a transaction. It looks kind of similar to a normal balance sheet, but you'll notice that cash and cash equivalents are moved down to non-working capital assets. They're specifically excluded due to that cash-free and debt-free basis. Other receivables are excluded per this schedule, and what we would say is in the purchase agreement, you always have either an exhibit that's referred to define working capital, or it might be narrative in nature in the purchase agreement. Either way, we want to make sure that the analysis being done to set a target net working capital, and a target net working capital is that normalized working capital that's kind of outlined and stated in the letter of intent. but you want to make sure that those two mechanisms agree, and that way there's not any unintended consequences for mismatch. So some of the areas like accounts receivable and inventory, accounts payable at the surface level look like normal net working capital items, even cash-free, debt-free. Retainage receivables on a construction company. I guess we didn't model this out very well with just $3,000, but a normal construction company, that might be a sizable amount. And there might be a sizable amount of accounts payable for retainage as well. And some of those stretch 2 years. Some of those stretch longer if there's contention on the projects. So whether that should be included or excluded is a judgment call, or partially included or excluded, and I'll go through an example of that later. But the idea is to kind of outline, at least at a surface level, based on the financial statements or the trial balance, what kind of key areas are going to go into net working capital, be included or excluded. So what I just showed before was reported net working capital, and then on a surface level based on the financial statements or trial balance. And then there's adjustments that can be made from there, either from the seller's perspective or the buyer's perspective. So the seller can scrub through their detailed financials detail, or the buyers will be doing it during their due diligence and quality earnings process. But you start with kind of what's easy to outline, reported, and then you make adjustments from there. So in this example, we had a client that their largest customer stretched their accounts receivable terms from 60 days to 90 days. And that 30-day increase had a decent impact on the net working capital amount, where we calculated what, had they been subject to 90 days in all past periods, what that would have impacted net working capital in the historical periods. So it's kind of a pro forma adjustment, but based on current context. We outlined a couple retainage and payable normalizations for retainage that was kind of past the normal course, where it was, and this was on a sell side project where we outlined, okay, they normally have 1 year, the retainage usually stretches 1 year. This was stretching more than 3 years. So what's kind of the base case and normal situation that should be in? And by the sellers having a negative reduction to net working capital, that would mean that they would have to, in essence, deliver less net working capital at closing. On the other side of the equation, though, this is a construction company, has retainage receivables, but they also have retainage payables with subcontractors. So what's the other side of that impact? And you can't usually just have the good side of an adjustment. You also have to take the negative. But in total, we were able to argue that this would be a negative reduction in net working capital, and therefore good for the seller. Inventory normalizations. The company only started accruing or counting inventory in May of 2018 in this example. So we came up with a calculation to right-size inventory past periods. Putting accrued payroll in the books, it's pretty easy. Dated payables is kind of an interesting one, because as you look deep into the AR ledger, or the AP ledger in this case, you start to find details that the accounts payable, maybe there's old accounts payable in there that haven't been paid for over a year or 6 months. And if you're buying this company, you don't want to have to assume those liabilities. And if you have them as an adjustment, here it's a positive impact to net working capital. Similar case with related party payables sitting down there in the AP subledgers. Okay, so next, just getting into a little bit of specifics about how trends work in net working capital, and kind of analyzing. This is the third step in the process, but just analyzing how net working capital is fluctuating over time, and as a company is buying this business, how much working capital they want the sellers to deliver at closing, or if you're on the sell side, kind of how much you're probably going to have to put up in working capital at closing. It's working capital is relatively easy to establish if it's a steady state business and there's not a lot of fluctuation month to month in net working capital. Once there's higher growth in revenue and net working capital, or there's significant seasonality in the business, then things fluctuate. And there's more interpretation about what should be done with net working capital. So these are two different examples and in thousands, but you have a business that has obviously experienced some growth in working capital, and in that case, in high growth, usually the seller just wants to use a 12-month average. They say as sellers, well, the EBITDA was based on historical EBITDA, which maybe was the basis of valuation, was based on a 12-month average, total of 12 months, so maybe there's some basis there. But as you can see, if you buy this business in the next 6 months, next 3 months perhaps, it's going to increase significantly, and that buyer is going to have to fund not just their proceeds into the business, but likely some additional capital to keep things moving in this direction unless something else changes. The bottom table is related to the previous slide, just showing the impact of what a trailing 3-month average is versus a trailing 6-month average versus the trailing 12-month average. And you can see, depending on if the buyer and seller agree to use a trailing 12-month average versus a trailing 3-month average, it can have about $1.5 million swing. And that $1.5 million swing that gets established as the target in the purchase agreement is real cash that does not go over to the seller. On this next slide, just outlining, or just kind of showing an example of net working capital in a seasonal business that has one significant high season versus one significant low season. Again, the dollars are in thousands, so we're talking about pretty large dollars here, and a significant, probably a line of credit that's used during the high season. And this is still in that third step, the analysis part of working capital, and what the kind of the sale or acquisition of that working capital is going to be. There's conflicting views on this a little bit, but usually what happens is as the deals get negotiated, sellers sometimes want to try to time the sale of the business to when they're in a low season, and buyers might want to try to time the sale or the purchase of the business when it's in a high season. Obviously, both of those things can't happen. So you're left with either A, buying it at a midpoint in the season, or B, having another mechanism to kind of supplement the valuation, because you're valuing it based on maybe a multiple or cash flow, but you're also going to have to maybe fund working capital in the future as the buyer if you're buying it during a low season, and maybe that then should be a reduction, partial reduction in the total consideration given. So a lot of times we see where you actually use an average over an entire season. So if there's 2 seasons, you might use the average over the most recent 2 seasons, or if it's an annual business, you might just use a 12-month average. And kind of another way to put this is, by the seller selling in a low season, they'll likely already have reduced, so they'll probably have reduced proceeds for what we call deficient working capital at closing, as compared with what gets established as the target, and maybe the target is that yellow line. We consider this relatively fair, as the seller's bank account actually already has additional cash in it, and in a cash-free, debt-free transaction, they get to sweep away that cash, or their debt payoff on their line of credit is much lower. So it's not, they didn't get to cash out and keep all that cash. They probably had to reduce the proceeds on the purchase price by maybe that deficient amount of working capital. So some interesting stuff around seasonalities with businesses. With that, we have our third polling question.
All right, polling question number 3. Which types of liabilities are usually considered debt-like?
That's right. So current obligations on capital leases, when you're talking about a transaction. So debt-like is a term used in mergers and acquisitions related to what looks like debt, smells like debt, maybe should be paid off by the sellers at closing. But to be to be argued, obviously, by either party. So we worked our way through steps 1 through 3. Now we're at step 4, which really isn't a step other than where the buyers and sellers come to the table, kind of hash it out and figure out what that number is going to be. And sometimes this step is earlier on in the process, and sometimes it's at the very end, like it's outlined here. But the buyer's objective really is to establish a target net working capital as high as possible. That way, there's as much in AR and inventory in the business at closing as possible, and there's the least amount of liabilities that they're going to assume. Or even if they do assume them, they're funded by the sellers. The seller's objective is obviously to have the lowest possible net working capital target, because that means that they're going to extract more cash and proceeds at closing. Obviously, steps 1 through 3 lead up to this in this example, and there are a lot of detailed work and analysis that goes into it, but that's the general idea. All right, so once the target is established, it's written and memorialized into the purchase agreement. The definitions are outlined, so you have, or there's an exhibit or an example provided. So now you have kind of a framework and a kind of the first hurdle, the first benchmark to go off of. And at closing, then the seller's kind of is responsible for preparing a net working capital calculation at some level of detail, and usually, which then feeds into usually a closing statement. The buyer's responsible for ensuring that statement is calculated reasonably. They usually don't dig into significant detail at that point, but for sure they want to make sure that the exhibit or example includes and excludes the correct items. If that's an exhibit in the purchase agreement, that becomes memorialized, and that's what then is used in the next phase. As I've mentioned before, any excess net working capital delivered at closing is additional proceeds to the sellers, and any deficient working capital delivered at closing based on the estimate is a reduction in proceeds. And it's important to remember this is truly an estimate at this point. It's, companies usually take 5 days to 20 days to close their financial statements. Sellers are being asked to close their financial statements 2 days in advance of the actual balance sheet date. So obviously there's going to be changes after, but it is recommended to make this as reasonably accurate as possible with all things considered. All right, so on to step 6, the closing of net working capital and the true up phase. So this is where it all comes to kind of a head, and it finally gets, this whole process comes out. The closing balance sheet is delivered by, I don't know if everybody can see those little arrows down at the bottom, but that's delivered by the sellers at closing. That's the estimate. That's kind of their ballpark numbers for where they think it's going to be. And net working capital is maybe one of these items in this closing statement. So at 6.9 million is what they estimated it to be. And maybe it's compared to a target of 6.5 million. That means that the sellers, in addition to their $25 million enterprise value, they got to add, in simple terms, $459,000 of additional value to what they got paid at closing. There might be an escrow account set up to take care of any post-closing adjustments based on what the buyer then assesses working capital to be. And at this phase, then now it turns over to the buyers. The buyer now owns this business. The buyer controls the books and records, and so it's to the buyer usually to go in, usually with a 60-day or 90-day. We've been seeing 120-day periods to assess working capital to what it actually was at closing. And you can see, obviously, in this case, the buyer is suggesting that there was $515,000 less of net working capital at closing than what the seller initially estimated. So this would usually, if it ended here, this would be taken out of the escrow account, or funded. If there wasn't enough in the escrow account, it would probably be have to be owed back by the sellers. So in a deal that's 20 million or 25 million, 500,000 stings a little bit. So at this point, the the sellers do have a right to go in and see that the buyers prepare the closing, the revised balance sheet correctly, that they agree with the assumptions that they made. A lot of times, you have a new accounting staff doing the records. They might try to do it reasonably consistent with how it was being done before, but there's a lot of gray area here, as you can imagine. So there's a lot of, we set the bar at the target amount, then there was additional proceeds, and now maybe the reduction in working capital makes sense. It's a lot closer to the target, but maybe it doesn't. Maybe working capital is actually higher than they initially estimated. So the buyer really wants to make sure that they understand this post-closing adjustment. We've seen this adjustment come to as much as, I think it was like 2.1 million on a $21 million sale, so like 10% of the enterprise value. And we got brought in as the seller's advisor to really understand what that working capital balance sheet should have been. We were able to get it down to, I think, a $300,000 adjustment, which still stings. Don't get me wrong, but it's much better than 2.1. So with that, we have our fourth and last polling question.
Okay. The fourth polling question here. What is the seller's primary objective with net working capital?
The seller's objective is to have the lowest amount of net working capital target. That way they deliver the lowest amount of assets at closing, the lowest amount of hurdle that they need to make that won't reduce their consideration and proceeds. I guess the question maybe should have read net working capital targets.
Tricked him again, Kyle.
Tricked him again. You're right. All right. So we're at the end of the 50 minutes, but just a few closing remarks. Just kind of remind everybody that when you're talking about when people are talking about net working capital, that kind of term can mean many different things, and should be thought about in the correct context. Just also keep in mind that a high amount of net working capital is positive and negative. It might be useful to have that inventory on hand so you can sell it in case that it's not readily available or it's hard to procure. But it also would be more efficient for the business to run, and there'd be more cash on hand with that cash as king. If there was less inventory and less AR and things of that nature, it can have an impact on the valuation of the business and the ability to fund growth. And finally, the working capital area of a transaction with mergers and acquisitions is somewhat complex, and it's kind of infamously contentious area as it relates to deals. So there, in any given transaction, there's usually some degree of winning and losing on this topic. But you also, the idea is for it to be neutral, but the people with the best understanding of it and the best knowledge and the most details usually come out at least neutral or a little bit of a winner. Chad, any kind of closing remarks you want to add?
Yeah, just real quickly, I think as I've worked with clients and gone through this process, one of the most valuable exercises is to actually go through and mock up a closing statement. So go through your balance sheet, show what your understanding of the deal terms are in terms of how the net working capital target works, what a closing statement might look like, what a purchase price allocation might look like. You might find out that your understanding was different than the other parties. And I think visually, when I've seen sellers and buyers do this, they do come to, they become turned into the same page on terms of these deals. And really, as Kyle mentioned, this is an area that is disputed quite a bit, not only in terms of what the balance sheet looks like as of closing, but what should have been included in working capital. And so I think going through and visualizing what this looks like in terms of net proceeds to seller and what the balance sheet looks like for buyer can be a very helpful exercise.
With that, Amy, do we have time for any questions, or has there been any questions?
Yes, so if anyone does have any questions, you can use the Q&A box located on the menu bar. You can also use the chat feature. And we did have one question come in. Is there a good resource for benchmark ratios by industry?
You know, there certainly is, and I'm glad that question was asked. We used RMA a lot. So that gives us most of the metrics that we like to see. There's also MicroBuilt. We buy, I think it's $30 a report. You can get any NAICS code, and it has even more metrics to look at. Also, there's other ones. IBIS World, ProfitSense has some industry metrics. So there are a lot out there. Some of the best come maybe from an industry group that you're in, but if it doesn't have it, there are those other commercial sources. And reach out to us if you ever want to see something we might be able to share with you.
Awesome. Well, while we're waiting for a few questions to come in, you can see a list here of our upcoming June webinars. And if you do want to participate in those, you can just visit our website. And if you do want to reach out to Kyle or Chad, go right ahead. Here's their contact information. It was also sent in the handout that was emailed yesterday. You guys, there's no questions coming through.
All right. Have a good day, everybody.
Thanks,
Amy.
guys.
Bye, everyone. Thanks.